Plan B's stock-to-flow or S2F model posits that Bitcoin's price is fundamentally determined by its scarcity. This scarcity is measured as the ratio of its current stock, the total number of coins in circulation, to its flow, the number of coins produced annually. According to the model's thesis, as the annual production rate, or flow, is systematically reduced by halving events, the stock-to-flow ratio increases, thereby driving up the price. Mathematically, the model is often represented as model_price equals A times the stock-to-flow ratio raised to the power of B. For example, one version of the model employs parameters such that model_price equals the exponential of 1.84 times the stock-to-flow ratio raised to the power of 3.36. This formulation captures the idea that the predicted price is a power law function of the stock-to-flow ratio. In this framework, a higher ratio, which indicates greater scarcity, is expected to result in a higher market value for Bitcoin. Historically, the model has been used to generate specific price targets based solely on supply-side dynamics. Early predictions after the 2020 halving suggested that Bitcoin's average price would reach around $55,000. More recently, updates to the model have indicated that during the current market cycle, Bitcoin could average approximately $500,000, with a potential range spanning from a lower bound of about $250,000 to an upper bound of around $1 million. Furthermore, some long-term extrapolations derived from increasing stock-to-flow ratios forecast that, if current trends persist, Bitcoin's price might eventually approach values as high as $4 million in subsequent cycles. Despite these enticing forecasts, the S2F model has been criticized on several scientific grounds. Critics argue that its reliance on a tautological formulation where the model essentially states that the price is a function of the current stock leads to spurious correlations rather than revealing a genuine causal mechanism. In addition, because the model is heavily based on historical data, it suffers from significant autocorrelation, which, when corrected using advanced time series techniques, often results in a dramatic drop in statistical significance. Moreover, by focusing exclusively on the supply-side factors, the model neglects critical demand-side influences such as investor sentiment, regulatory shifts, and macroeconomic dynamics, which are known to have profound effects on Bitcoin's price. Cryptocurrency markets, characterized by fragmentation and nascent regulatory oversight, present unique inefficiencies that astute investors can exploit. The lack of a central clearinghouse or universally adopted valuation methodologies results in disparate pricing across exchanges and geographical markets. This environment creates fertile ground for arbitrage strategies, wherein price discrepancies are systematically leveraged for profit. Moreover, the advent of decentralized finance platforms has introduced novel financial instruments, such as yield farming and liquidity staking, that enable investors to earn returns independent of price appreciation. These mechanisms, while inherently risky, represent a paradigm shift in the conceptualization of wealth generation, emphasizing participation in the underlying infrastructure of digital ecosystems. The wealth generation in cryptocurrency markets is inextricably linked to the cyclical nature of market behavior, with the bull run phenomenon echoing the speculative bubble theories of economists like Kindleberger and Minsky. During these periods, the confluence of heightened liquidity, technological optimism, and speculative mania results in exponential asset appreciation. However, these cycles are invariably followed by corrections, necessitating a robust understanding of entry and exit strategies to capitalize on wealth-generating opportunities. The proposition that cryptocurrency markets can serve as viable engines for wealth accumulation is neither universally valid nor entirely illusory. Instead, it resides within a probabilistic framework contingent upon the investor's capacity to synthesize market intelligence leverage, systemic inefficiencies, and exercise psychological resilience. As the cryptocurrency ecosystem matures, the interplay of technological innovation, regulatory evolution, and market sentiment will continue to redefine the parameters of wealth generation. For those equipped with the requisite acumen and risk tolerance, the potential for transformative financial outcomes remains a distinct, albeit uncertain, possibility. An unidentified participant executed a strategic maneuver in the crypto-economic sphere by converting a nominal capital outlay of $27 into an astronomical $52 million through the acquisition and subsequent transfer of the Pepe meme coin, an asset characterized by its mimetic origin and negligible intrinsic utility. This transaction, meticulously documented by blockchain forensic analytics at LookOnChain, exemplifies an extreme manifestation of nonlinear capital amplification. yielding a return multiplier on the order of 1,900,000 times, and emphasizes the profound impact of emergent liquidity phenomena within digital asset ecosystems. The underlying dynamics of this extraordinary event are deeply rooted in the interaction between stochastic market behavior and the idiosyncratic characteristics of decentralized finance. The prolonged dormancy of the asset, spanning approximately 600 days prior to its redeployment, suggests a deliberate strategy of temporal arbitrage and long-horizon speculative positioning, wherein the trader capitalized on the inherent latency and asymmetry of information dissemination within blockchain networks. Theoretical frameworks suggest that such behavior is driven by market microstructures, where low liquidity thresholds and reflexive investor sentiment lead to exponential asset price increases, even without tangible economic fundamentals to support them. Moreover, the case presents a compelling paradigm for analyzing the emergent properties of cryptographic markets, where mimetic value generation operates through mechanisms of social contagion and network effects. The rapid algorithmically induced fluctuations in asset price, coupled with the non-fungible nature of collective digital narratives, create an environment ripe for extreme capital multiplications that defy conventional risk-reward metrics. This phenomenon invites rigorous inquiry into the application of advanced stochastic modeling and on-chain forensic analytics to better understand the confluence of decentralized liquidity provision, behavioral finance anomalies, and the power law dynamics that govern asset pricing in these innovative financial architectures. Building on this analytical foundation, these insights take on real-world significance in the fast-evolving landscape of algorithmic derivatives trading, where cutting-edge strategies emerge at the intersection of advanced modeling and market dynamics. In the vanguard of algorithmic derivatives trading, the integration of long positions in established large-cap cryptocurrencies and short positions in hyper-volatile meme tokens via Bybit's futures combo bots constitutes an avant-garde strategy yielding up to 1,700% APR. This dual-momentum arbitrage paradigm employs an array of sophisticated quantitative techniques, drawing from stochastic calculus, multi-factor risk analytics, and nonlinear dynamic programming to exploit asymmetric market inefficiencies. At the core of this strategy lies a robust framework of multivariate time series analysis and Monte Carlo simulations, which underpin the probabilistic modeling of asset price trajectories. The deployment of stochastic differential equations, or SDEs, calibrated via Kahneman filtering techniques, facilitates real-time estimation of latent market states. Simultaneously, Bayesian inference and convex optimization methods, such as Lagrangian multipliers for constraint handling, ensure that portfolio weights are dynamically adjusted to maintain an optimal risk-return profile. This approach is further refined by leveraging deep reinforcement learning algorithms to iteratively optimize the rebalancing thresholds under volatile market regimes. Bybit's futures combo bot architecture allows for the simultaneous management of multiple derivative contracts, each parameterized with bespoke leverage settings, position ratios, and rebalancing triggers. The system incorporates algorithmic rebalancing based on gradient descent optimization, ensuring that any deviation, say a 10% drift from target allocations, is corrected in near real time. This automated recalibration mechanism employs a combinatorial optimization routine that minimizes value at risk (VR) and conditional value at risk (CVR), while exploiting nonlinear correlations between the underlying large-cap assets and volatile meme coins. For instance, a trader might allocate 30% of capital to long positions in highly liquid large-cap tokens like Bitcoin and Ethereum, while simultaneously shorting 70% of the portfolio in meme coins, exhibiting high kurtosis and skewness in their return distributions. The leverage-induced nonlinear risk exposures are meticulously managed through advanced risk metrics and hedging algorithms, ensuring that the portfolio's asymptotic efficiency is maintained even in the presence of intraday volatility clustering. The fusion of long large-cap and short meme coin exposures creates a synthetic position that benefits from divergent market dynamics. In this regime, the relatively stable upward drift of blue-chip cryptocurrencies counterbalances the amplified downside potential inherent in meme coins. This dual strategy not only exploits cross-asset arbitrage opportunities, but also benefits from the convexity effects induced by leverage. Furthermore, the high-frequency data assimilation enabled by low-latency trading infrastructure ensures that the model continuously recalibrates its risk estimates using non-parametric regression techniques and complex network analysis.